Good evening once more. So I'm here to speak about valuation, but I did forget to mention just two teams that I wanted to recognize before I get started with the session. I think the first is the entrepreneurs in the room. Being an entrepreneur is very difficult, so let's put our hands together to the entrepreneurs in the room. I always like saying that if the entrepreneurs are not there, then we wouldn't be there. And the guys who do the heavy lifting. Indeed, the heavy lifting. They live their days. I'm also an entrepreneur. I run my own entity. And I know what it takes to build a company from scratch. So welcome to all of you. And looking forward to listen to the pitches that you're going to have. Of course, it's really exciting to finally be able to meet with the team that you've been working with, the team that you've been training, who are going to be joining LAN, and they're going to be joining the alumni of the AAA. I'm seeing Sergi here as one of the teams that you've been training, and of course the ones which are online. I'd forgotten we have a team that's online. So whenever we do our trainings, we do them virtually. So I was telling Sergi earlier that of the 800 angels that we've trained under the Africa Angel Academy, I've probably met less than 100 of them because we started back in 2020, and I've been doing the trainings from that point. So it's always a real pleasure to meet with the angels physically. Okay. Dr. Solomon had promised that I had 2 hours for my training. And then when I arrived, he told me that he's going to cut that by quarter. So I have 30 minutes only. I'm joking, Solomon. So I'm required to speak about valuations in 30 minutes. Just for context, to tell you how hard that task is, whenever we do valuations sessions, there's one class especially we have which runs over 5 days. So, you go for 3 days and then you actually carry out a valuation and then you present it. But for this case, I'm going to have 30 minutes. So I asked myself, what's the best way of going through these? And I wanted to just quickly ask in the room, for those who came and were interested in the agenda, and they said, I'd like to learn something about valuation today. Is there one burning question that you came with that you feel, if this question is answered for me, I'll feel as if my evening has been worthwhile? Yeah. So I just like, if we just get 2 or 3 people just to put up their hand, I just like to get a sense of any question you might have when joining this session, so that I use the session in a way that adds value to you in the room. Yes. Can I have a microphone here, please?
So when I was watching the valuations stuff, I saw that there were different methods to value a company. And when some of the angels spoke about it, they were like, they usually don't only focus on valuation because it's very tricky. It's not straightforward.
Yes.
And because some of those startups don't have any traction yet, it's difficult to really value them. So what do you think is the most important thing to look out for in valuing an organization, especially an early traction startup, basically?
Okay, thank you. That's a good question. What's the most important thing to look out for when you're valuing an early stage company? Okay, brilliant. Let's think there's another question here.
I think for me, what I really want to understand is, you were talking of the multiple methods of valuing companies, but considering the facts, for instance, in Africa, where you don't really have a lot of technology companies, how do you reassess based on the developing versus the developed, and able to come up with what I would call more of a realistic valuation that is beneficial to the investor and also to the entrepreneur? Thank you.
Thank you very much. That's a good question also. I've written it down. Any other burning question that you might have? Let's get through. Yes, please.
Thank you. My name is Kiva. From the perspective of the entrepreneur or the founder, what would you say makes the valuation back and forth irrelevant? Because like she said, it gets tricky depending on the whether it's a technology company. Sometimes depending on where the investor is based, right? Because geography sometimes affects how people view valuation. So what would the perspective be on how a founder should approach the conversation so that we're not going back and forth on whether we agree on the valuation?
Yeah, thank you. Those are the questions that make valuation sessions 5 days. And so having asked those questions, I asked myself where to start. But let me see if my slides can cover some of these, because I do have some slides that speak to these. So I don't know how we're going to do this. Okay. We can jump onto the next slide. So I think this is just part of the data around the Africa Angel Academy. I already spoke about part of it. The number is now at 800, so we're very happy about that, and the countries are now at 28 African countries. And so we are an Angel Academy by Africans for Africans. You'll find a lot of content out there talking about training for early stage investors. The only challenge you'll face with that content is that it's not contextualized. And what we like to do is to, number one, have content that we've recorded that you can go through. But then secondly, and very importantly, is we feature some of the top speakers from the continent on the various topics that we're talking about, to ensure that when you're coming for our sessions, you're able to get the up-to-date content and up-to-date speakers. And I'm very happy that today we're going to be joined by one speaker, Fisayo, who's going to be sharing a bit more on negotiations, exits, and valuation also. Thank you very much. Can move to the next slide. So the Academy has two key partners, Victoria Ventures, which runs, I'm an angel investor based out of Kenya. I helped to set up the Victoria Business Angels Network. We have so far made 15 investments, and we keep making other investments every single year. We have 52 angels who are part of our angel network. Founders of Viridian is part of the founding team of Dazzle Angels, and so that's where some of the content then for the Academy comes from. We can move on to the next slide. If in there to make investments in different jurisdictions, we have an actual it's called a legal guide for making investments into Nigeria, which was created by lawyers based out of Nigeria. So you can visit and you can be able to download some of that content. Are we done with the intro yet? Can move to the next one. Yes, just before I forget, for the angels in the room, if you are interested, Thursday on the 11th from 4 p.m. West African time. So you're welcome to attend the session, and you can see some of the startups that we'll be pitching. I think we have startups from, we don't have a startup from Nigeria for some reason. Usually we have startups from Nigeria, but I think we have Kenya, but at least you're welcome to join us. Okay, I think that should be all the intro slides that I need to, now I have 22 minutes. The two key questions that we always get being asked are, number one, get the theory, but how do I apply it in practice, which I think is a question you are asking. Because, you know, there's all the theory, but then the moment you try to look for the data you need, the moment you try to correlate it to an actual startup, you find it very difficult. And then secondly, is we always get this question, how do you, on year by year basis and valuation, we'll come and ask you, so I know we've covered valuation and all that, but just tell me, how exactly do you value startups? And you'll be like, we've been doing that for the last 12 sessions. What's going on? So these are very important questions. So, and I think the way I've chosen to approach this topic is to look at the framework much more than the actual methodology. You have a lot of that content. So let me just paint some content in terms of the framework. So if you jump to the next slide, there's a theoretical method that we can speak about. The fact that we have the classical methods, the DCF, multiples, net assets. Then you have sort of like rules of thumb method, which have been borrowed from other ecosystems, mostly Silicon Valley. And you have a method called the VC method, which is what I want to focus on today, which I think might be the most interesting to think about. But in the next slide, I just want you to think about a few things. Number one is this idea that whenever you're valuing a startup, you're not looking for an accurate number. Yeah? Nobody's looking for the valuation for the startup is $3 million, 560,456.5 cents, right? Because you cannot get it, right? The key thing you're trying to do is to not overpay for the asset. Yeah. So valuation was million, but the actual value was 3, then there's a problem. And the biggest problem that you face in this case is that for you then to catch up, for you to correct costs, the startup will have to grow significantly beyond expectations that they had given you, than if you invest at the wrong terms. Right? Because when you invest in at the wrong terms, so to say, you already make your journey of early stage investing even more trickier than who does debt investments. And you're saying, we're talking about equity here, but let's also speak about debt for a second. He said something about debt which is similar. He said one of the biggest challenge about making debt investments into startups or into any company is when you don't size the debt correctly. Either you invest too much debt in a company that needed very little debt, or invest very little in a company that needed a lot of debt. If you invest too much that the company did not need, it just means that then they cannot be able to pay the interest because the interest is already too much from the day one. If you invest too little, then you have another problem where they may not be able to hit some of the targets that they expected, and so because of that, then you can't generate your return, right? So I just want to, from a framework perspective, we're not trying to get to the accurate number. We're trying to, but of course, you don't want to also significantly underpay. The challenge of significantly underpaying, where the startup was valued at 10 and you invested at a valuation of 3, is that at some point the founder feels that they were taken advantage of. And that is at times just as bad as feeling that you're taken advantage of. The significant dilution that happens because of the subsequent rounds of fundraising, in this case, then what happens is that they're not incentivized to put in the hours. They feel like it's an unfair deal. Right? So that's an important point. We can jump on. And so when you're thinking then about valuation, you can just put all the points. It's not about the actual number. It's about pricing. We're trying to price the deal. We're trying to find out what is the right price to put in money into these startups to ensure that, 1, there is proper incentive structures. 2, I will generate a return by making that investment. Of course, there's also those investors who look at it from an impact perspective. But even if you're looking at it from an impact perspective, you always want to have a sustainable business. Right? If it's not sustainable, at some point the impact is not realized because the startup then ends up folding. So I think I've mentioned that pricing is about if I pay X, will I make a return? There's many valuation methodology. And the other last point there about pricing is that it's always important to ask yourself, at what point are you in the market? So for instance, and I think some of the experienced angels in the room will remember this, if you're investing into a fintech in 2022, which was the height of the madness, right? People just needed to have a good deck and say they used to work for another startup, and they've created this fintech, money transfer, whatever it is, and the valuation would start at $10 million, right? And the thing I always like telling startups and angels is that I like translating the amount that the startup tells you in local currency, just to see whether it makes sense. Because at some point, it has to make sense. We can't just speak about dollars in this case. And so $10 million in Kenyan shillings is around 1.3 billion shillings. And so then I like taking 1.3 billion and asking myself, okay, if I look around in the ecosystem, what can I do with 1.3 billion shillings, right? But anyway, that was the height of the madness, right? But right now, the pendulum has swung to a certain extent. It's on the other side. So startups are not being valued in that. Startups were able to raise money and to raise subsequent rounds of funding, right? But now you cannot be able to do that. And so if you don't understand where the market is also, it's very hard for you to price. It's like real estate. Depending on where the market is, you know where the price generally is for a specific asset. Yeah. So that's some of the context you need to have when you're thinking about. So it's not about the actual price. It's about we don't overpay significantly in this case. We can jump to the next slide. Yeah, I spoke about that. So what we're really asking ourselves, and that's why I'm taking this session in this direction, is we're asking if we invest under the terms which have been proposed by a startup. Because what happens, what we'll hear from these startups today is that I'm raising $200,000, $300,000 at a 3 million pre-money valuation or 4 million post-money valuation, whatever the number will be. Right? That's what you're going to hear when you listen to a startup. Now, the one question you need to ask yourself as the investor is, assuming you want to make a return, and I want to assume that the investors in this room are not just looking for impact. You know, there's rooms you walk into and All the investors are looking for impact. And so whether they make money or they don't make money, that's a different issue. But assuming you want to make an investor as an angel investor, right? One question you need to ask yourself is, what kind of return do you want to make? So if a startup, for instance, gives you just your money back plus maybe a 10%, is that enough for you? If they give you two times your money, is that enough for you? If they give you 5 times your money, is that enough for you? What are you looking for? It's a number you need to roughly have, because it's going to affect how you evaluate the startups you're going to be investing into, right? Because once you can tell that, then you can start asking, when someone comes and tells you that invest into a startup at we're raising $300,000 at valuation, 10% stake, right? Then you can start asking yourself, do I really think, because for you to generate your 3x return, for your 200,000 to become 200 times 3, which is 600,000, guess what? The startup has to grow. It has to grow at least 3 times, right? And most often, not 3 times, because there's going to be dilution. There'll be other investors who come on board. It has to grow at times at least 5 times for you to generate your return. So then the one question you need to be asking yourself, if I look at this startup, the market they're in, the type of founders I have, etc., is it the kind of startup that I see moving from a $2 million valuation to a $10 million valuation, right? And if you don't see that, then it means that you cannot get your return, simply put, right? Now, how do you answer the question as to whether they can move from a $2 million valuation to a $10 million valuation? Let's jump to the next slide. Valuation levels have always been the same, and they'll not change, right? The numbers may be different, but these are the valuation levels. This is what causes a valuation to be different from one company to the other, right? The first thing is, of course, the team. For early stage companies, team, right? So what are you looking for? You're looking for, first of all, a team that understands the space they are in really well. They have technical knowledge, right? You're looking for a team that has the hustlers, as we like calling them. They can just make things work. They just know the ecosystem really well. If there's a problem, they'll fix it. They know the guys at, if they're a fintech, they know the guys at the central bank, they know the guys at the Capital Markets Authority. There's a way they can just weave their magic and they can get things. If they don't, they have someone who can fix that, right? You're looking for people who also have a lot of experience, to run a company at the end of the day, right? Because one thing we've realized, especially in the current ecosystem, is we are facing a bit of challenges with some of the founders who don't have experience running companies. And so then what happens is, yes, they'll raise the money, yes, they'll have the technical skill, but the ability to manage a team is a different thing altogether. They raise money. Because the moment we say that the kind of entity you're investing in has to grow 5x, 10x, people have to raise money. And to raise money, they have to stand in front of people, they have to convince people. I remember a startup in Kenya that we looked at and we never invested into. And I met an investor who put in money into that startup. I didn't believe in the story of the startup at all. And I asked the investor, why did you invest in this company? Like, the business doesn't make sense. He told me, you know what, I looked at that founder, and that founder can raise money. So even if, he told me, even if the idea is wrong, whatever idea they end up with, they'll be able to raise money for it. And I invested because of that. Right? Of course, the startup ended up folding at some point. But, I mean, raising money is such an important skill set to have in this line of work. Right? And I would say the skill set that you can outsource, but raising money you cannot outsource, right? The ability to pitch really well, the ability to convince people and to make people trust you as a founder, that you know what you're saying and you'll take care of their money and you'll help them multiply. You cannot teach that, unfortunately. You cannot outsource that, sorry, right? The other skill set, like, I don't know, someone experienced in something, you can hire for that. Whatever, you can hire for that. But the other one is a very personal kind of touch with investors, where you look them in their eyes, they look at you, they feel comfortable that we can give this guy or this lady this amount of money at a $10 million valuation, even when it's on PowerPoint. Yeah? Okay. Second thing is traction, right? Traction. Yeah. How much has been done before you come and raise? Yeah. 2022, a PowerPoint deck was enough as traction. 2025, PowerPoint does not count for anything. Now investors are starting to ask, okay, what's your average monthly recurring revenue? What's your annual recurring revenue? And so forth. Those questions are being asked, right? There's even questions around what's your pathway to profitability. When you share with us your financial model, there's a question in terms of how do we how do we make sense of the numbers you're giving us in terms of how you're going to be able to scale these and get to a profitable space and, you know, scale and so forth. So that traction is important. If you have better traction to your question you ask, how do you pitch your valuation and avoid it being back and forth? Traction. If you have better traction, valuation is more certain than when you have zero traction. When you have zero traction, then it's an issue. Do I believe your story or don't I believe your story? Do I have a different version of the story, right? If you're discussing unit economics with an investor and you're saying this is how it works, but you've not done it yet, then the question is, I've also seen it being done in a different space, and the margins are not 50%, the margins are 20%, right? And so then it becomes very difficult. But if you have traction where you can say that we've already sold to, I don't know, 2,000 customers, 5,000 customers, and these are unit economics, based on that, you answer that question very easily, right? Such an important point. And then, of course, market size and product differentiation, which is just how big can this go? Is it scalable? Right? And scalability, I like reminding people, it's not just about the business. Yeah? Can it scale from Nigeria to, I don't know, Kenya to Egypt to whichever market? Right? But it's not just about whether it can scale in theory. It's whether the founder can scale it. Yeah? There's founders you meet with, and you just get a sense they cannot scale this thing because either it's not their passion, either they don't have the right kind of skill set to be able to scale it, but such an important point, can they scale this in this case? And the reason for that, and we're having a discussion earlier, I think with a gentleman at the back, is that unfortunately for the continent, for you to really create, if you want to create a business that has to be a unicorn, it cannot be in one market. It has to be in multiple markets. Because you need to generate a certain amount of revenues, and to generate those kinds of revenues, especially if it's a B2B, even if it's a B2C, you find that the middle class that you need to be able to pay for that are not found in only one market. You have to go to multiple markets, right? And that makes things, you know, challenging to a certain extent. So the founder has to be the kind of founder that you can see they can be able to scale these to multiple markets in this case, and so forth. And then, of course, there's a business model in this case. And I'll let those statistics just sit there for now. But the team, level of traction, market size and product differentiation, and so forth. The most important point, the team. Right? Anytime if you have a founder who, I don't know, if the founder of Paystack, Shola, came and told you, hey, we are doing a new startup in fintech, we're starting out at a valuation of $5 million, we've not done anything, we have just PowerPoint slides and so forth, versus if I come and tell you the same story, which valuation sounds more believable? I guess Shola's sound was, because he has experience in that space. So the quality of the founder is the biggest point by far that helps in terms of justifying valuation. We can jump to the next slide. So I want to speak very quickly about a method, and I hope for the people in this room, if you don't understand this method, because I have only 6 minutes now remaining. I don't know how much time Solomon will give me. But I want to speak about a method that I think, over and above all those theoretical approaches, DCF, multiples, etc., will help you as an investor to make sense of the valuations that you receive. Right? And remember here, I've taken the viewpoint that I'm talking about equity investments only. If you're making, of course, investments into self-liquidating instruments, being debt, being revenue-based financing, convertible notes, and so forth, that's a different class, because then this class is not relevant, right? These considerations are not important. So I've taken the view that here we're talking about startups that you're investing into, and you're saying, you know what, I want to get a 5x return, I want to get a 10x return, and so forth. Okay, so in this venture capital method, before we start, it's called that because it's used by VCs a lot, right? Before VCs make an investment into an early stage company, they have to ask themselves, realistically, how much return am I looking for? And they'll say that we want for each startup we invest into to give us at least a 5x return, right? 5x return over the next maybe 5 years. That translates somewhere like 30% IRR. 30% IRR compares really well to what the bank pays you as an interest. So if they tell you the interest rate is 15% or 16 or whatever the figure is, 30% is that consistent 30% over 5 years, then you realize your return. So they have that. And the reason they have that is because the money they have is not their money. The people who've given them the money to invest have told them that at the very minimum, we need you guys to do maybe a 15% or 20% IRR. And so the 10% is what they call carry. And so on that carry, then they'll get paid. Right? So they have that. And as an angel, you need to have that at the back of your mind. It doesn't have to be cast on stone, but at least it's a lens through which you're going to be able to evaluate the startups. Now, one thing that then the VCs will do is that if they look at any startup and they're given any terms, in this case, they're told that, I don't know, 200,000, it's a fintech, put in 200,000 at a valuation of $2 million. Put in 500,000 at a valuation of $5 million. The first thing they'll ask is that if we invest under these terms, do we believe that if our exit horizon, the period within which they're investing and when they expect to exit, assuming it's 5 years, do we believe that in 5 years we can make our 5x return? Right? They'll ask that question. And if they can't answer that question to the positive, they'll pass because they'll say it's too expensive for us. Yeah? If they get a sense that they'll make a 3 times return, then they'll say too expensive, the valuation needs to be lower. So that's the time they'll come back to the founder and say that we cannot invest at a $2 million valuation, we can only invest in a $1 million valuation because the $1 million valuation justifies a 5x return in 5 years. Right? And if they can't answer that, they will not invest. Right? So what this method tries to do is to query the numbers you have in front of you and see whether you can generate the kind of return you expect in the period that you've set out as your investment horizon as an angel investor. Now, very important to note 2 things. As an angel, if you want to exit, you can exit in 2 ways. Exit is the sale of your stake. Number 1, you can do a secondary exit. A secondary exit is, and this has happened in a couple of deals. I think even, I don't know that this happened in Paystack, but I know in a couple of the deals in Kenya, I've seen this happening, and I'm sure it happens here also, is where you've invested your 200,000 at a $2 million valuation. That's a seed stage. Yeah. The company goes through another round of investing at I don't know, $10 million valuation. They raise $500,000 for argument's sake. Then they go for a Series A investment. In the Series A, the valuation of the startup is now $20 million, and they're raising $3 million for argument's sake. So during that round, the investors who are coming on board, they come and say, you know what, if anybody wants to exit, please put up your hand. And so as an angel, you look at it, you're like, I invested a $2 million valuation. The valuation for this company at this point is 20. That seems like a 10x investment. You put up your hand and say, please, write the check. I'm ready. And then they tell you, but wait a second, there's going to be a discount. Yeah. Because you're not staying all the way till the end, we're going to give, there's going to be a discount. We'll not give you an exit at 20 million. There'll be a 20 or 30% discount in this case. So for the people who are exiting, we'll make sure that the valuation in this case is not at 20 million, but at 70% of the 20 million, which is $14 million. So if you look at your money, still 200,000, 2 million versus 14, in this case, that's a 7x, more or less, assuming there's no dilution. So you say, please give me my money, or at least give me the return on top. Right? I'll leave the initial 200,000. So if, for instance, my money is growing by 5 times in this case, 200 times 5 is $1 million. So give me 800, keep the 200, just in case it's a unicorn. Right? That happens, right? That's a secondary sale. Yeah. Your plan is to exit in 5 years' time. Right? In 5 years' time, the company has a turnover of $3 million. The multiples for an Uber type business are known. It's 3 times. Yeah. So you can see if the multiples hold and the company performs exactly as they say they will perform, then it means in 5 years' time, the valuation will be $9 million. Right? This is not a real example, it's a simplistic example, right? $9 million. Now, the key question to ask yourself then, if the company goes to a $9 million valuation, will you realize your return if you invested $100,000 at $1 million 5 years ago? That's the question you're asking yourself. So let's move to the next slide. So I've already asked that. We can jump to the next. And your return in this case, as we mentioned, is that you want to make a 10x return, 10x. So you want your 100,000 to be $1 million. That's your minimum expectation. Of course, if you make 20x, it's better. right? Now, always remember this. The reason why you're taking this process is not to mean that all the startup will actually give you 10 times. It may end up giving you 0. It may end up giving you 2. It may end up giving you 20 x your money. But you need to be convinced at the point of investment that indeed it can give me that return. You know why that's very important? Because the reality is not all the startups you invest into are going to give you a return. If anything, a majority may not give you a return. So they say that in VC or in early stage investing, what you want is to believe that any startup you're investing into can pay for the entire portfolio. So if your portfolio is going to be 10 companies and you're going to be investing an average of 100,000, each startup can pay for the portfolio. At least you need to believe that. If it doesn't, it's okay, because then that is already built into the model. But if it does, at least you make your returns. I hope you're together. Eh? We'll ask 1 or 2 questions. So you're looking for your 10x return in this case. So you need to generate a 58% return. In 5 years' time, you need to generate your 37% return in this case. So let's move to the next one. Let's move to the next slide. So you have $1 million. So for you to make your 10x return, it means that in 10 years' time, when the company is valued at 9.9, you need to have a 10% stake. Yeah. Now, the reality is that you will not have a 10% stake for the simple reason that the company will have to raise multiple rounds of funding, right? And so if we jump to the next slide, the minimum equity is not achievable because of dilution. Whenever the company sells a stake in each round, what happens is that you get diluted. Right? If you don't participate in the next round. And of course, if you participate in the next round, you're putting in more cash. We can move to the next slide. And so in this case, a startup will have maybe 3 to 5 rounds until they get to the point of exit. And so in this case, assuming that the startup is diluting 15% every round, if you're going to wait till the 5th year to generate your return, then what this means is that there's going to be 3 rounds of dilution, 15% in the first round, 15 in the second, and 15 in the third, so a 45% dilution. So the equity you started with of 10% will reduce by 45%. And the next slide is speaking about that. So in this case, you will see 15% during those rounds of investing. And here, remember what I mentioned. We're not trying to get to the accurate valuation. We're really just trying to ask a question. Do I think that I'm overpaying for these assets, or am I paying the right price for the asset that I'm about to invest into? And the next slide then talks about the dilution. And so in this case, if you expect a 15% dilution during that period, it means that in the next slide, you'll end up with a 5.5 stake by the time the startup is coming to an end. Now, you may think that we're making lots of guesswork, but this guesswork is based by the history of funding startups in the continent. That every round, guys will dilute 10 to 20%. You need to raise a certain amount of money to get to that figure, etc. And so, if you're going to get a 5.5% stake at the end, to the next slide, then it means that if you're to look at how much value you get at 5.5% in this case, so this is here we're computing the minimum equity you need to be able to raise your 10x return. But even if you just think about it, what is 15% of $9 million? Someone with a calculator? Yeah. So sorry, 5.5% of the $9 million. Anyone with a calculator or someone who's... Sorry? Slightly over 500,000, $495,000, right? So basically what you're saying is, if you invested in the terms that the company has given you, as at the 5th year, the likely scenario is that you'll make 5x your return, not 10x your return, right? Now, if you're comfortable with a 5x return, you could go for it. But if you're uncomfortable with a 5x return, and you want a higher return, then it basically means that the startup is overvalued at that point. Right? I hope it's making some sort of sense, right? And in this case, then the negotiation with the startup will be, or with yourself is, do I take the terms as they are, or do I push back on the valuation so that the valuation comes down? I get a higher stake, and so by getting a higher stake, it means that I don't get as much dilution over the next 5 years. Then it follows that at the 5th year, I'm able to get a higher return than 5 times, but 10 times, 6 times, whatever the figure is. You get the thinking. So all VCs, before they make the investment, they go through this process. They go through this process where they ask themselves, how likely is it that I'll be able to generate my return? That the company will be able to grow 5 times, 10 times, 20 times, and I'm able to generate my return, so to say. So I'll just flick through the other slides because I don't think they're important. I've already made the point in this case, 150,000 etc. But where I want to sort of like leave this conversation as we finish. So, assuming I was going the secondary route, where I say, you know what, I don't want to wait for 5 years, I don't want to wait for 10 years. I've seen the writing on the wall in terms of what's happening with startups in the ecosystem. So I want my check as early as possible. So what I'm asking myself is, can I get a 3x return in 3 years? Yeah? Can I get a 3x return in 3 years? Maybe you're a simple person. You're just like, I'll put in 100. If I get 300,000 within 3 years, you know, I'm happy. How do you use this methodology? Right? So just jump to the next slide. Not that, the next one. Here you are, right? So in this case, you're saying I want to exit in 2027. So you'll be asking yourself, what's the turnover of the company in 2027? The turnover is $1.4 million. Times the 3 times, in this case, this is a multiple we saw, 2.93 for Uber. The valuation as at that point might end up being around $5 million, $4.8 million, right? Now, $4.8 million, if I apply the 30% discount, because remember I told you for secondary transactions, there's always a discount. I end up with a figure of $3.4 million. $3.4 million, in this case, 10% of that is 340,000. So, on that basis, and assuming there's no dilution, based on my $100,000 of investing, there's a possibility I get the 3x. And so this could potentially be a startup that passes the test of, can I generate the return I expect if I invest based on these terms? If I'd done this and ended up with a figure of 2x or 1.5x, I would have said the valuation is overpriced based on what I'm looking for in the market. I'm going to stop there because I've already gone over time. But I hope you get the sense. I did not answer the question you wanted, which is how do you carry out a DCF and so forth? Because I think even if you do that, you know, the one thing they can tell you about any financial model, anyone who's in the finance space can tell you, is that all financial models are wrong. Because there'd have to be a miracle for all the items you forecasted in a DCF, right from the turnover to the expenses to, you know, the cost of capital to all those different things, for those to be real and to happen as you expect, right? And so for me, I like using this approach because, yes, it's not as complex, but you can have a proper conversation as to whether this makes sense or it doesn't make sense, and you can decide to make your investment. We're going to stop there, but if there's 1 or 2 questions I can answer, or we're out. No questions at all. After. Okay. I've built over 500 DCFs, just for context. And even after you do the stress tests, you're doing the stress test on the basis of assumptions that you've created, right? Yeah. No. And I, as a finance person, I think you'll agree with me that for startups, DCF don't work. For mature companies, they make more sense. Yeah. We're talking about this from a startup's perspective, FYI. Okay, cool.
Please, a round of applause for Stephen Gugu. Thank you so much for taking your time, you know, with doing the deep dive valuation session. Thank you so much. Please, a round of applause again for him.